Welcome to our second quarterly investor call of 2021. This call is being recorded and will be available for replay by visiting www.o'keefestevens.com and clicking on the resource tab and then selecting the value conversation link. Before we get started, we must remind you that the purpose of today's call is educational and the material presented is publicly available information from sources believed to be reliable. The information in this material may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. This call is available for replay on the O'Keefe Stevens Advisory website located under the Resource tab. Please contact us if you would like a link to the recording of this call or any previous calls.
Thank you, Carly, and thank you for joining us on this call today. Our team has an exciting update to share with you, and before we get into that, I'll do a quick rundown of our agenda for today. Like our previous calls, I'm going to provide an update on the markets and economy. We've seen a resurgence in value investments since November, and I'll comment on what's going on there as it relates to the broader markets and to some of the specific sectors in our portfolio. Next, Peter's going to share a segment from our investment process, the 10 beliefs that guide our decision making. We've spent a lot of time developing these many years ago, but I don't think we've ever shared them on one of these calls. And then we'll get into a discussion about the future for technology investments that we currently own. The four holdings we're going to discuss today are NVIDIA, Qualcomm, Corning, and Intel. These are four businesses we think are positioned to compound shareholder value over the coming years due to the expanding 5G network and Internet of Things expansion. And more devices become connected to the internet, the demand for these products and these companies will grow too. So finally, we'll answer any questions that were submitted prior to the meeting. We thank you for those of you who sent those questions in before the call today. And if there's time, we'll open the lines for additional Q&A at the end of the prepared remarks. You can use the chat box during our talk if you'd like to submit a question in our queue. And Carly will read those questions at the end of the call, and we will respond to each question individually. But before we get into the call information, we've been keeping some exciting news from you for the past 2 weeks. On April 1st, our team added its newest member, Dominic D'Angelo. Dom is joining Peter to form our research team. This is a hire we've planned over multiple years, and we're excited to bring Dom on now that we have the role created and have found the person that best fits our organization. So Dom is here with us on the call today, and I thought it'd be nice to allow him to introduce himself and provide a little background on his work experience and what brought him to O'Keefe Stevens Advisory. So welcome, Dominic.
Thanks, Justin. Good afternoon, everyone. My name is Dominic D'Angelo, the new research analyst at O'Keefe Stevens. I cannot begin to tell you how excited I am to join a firm that I've admired for several years. I went to Canisius College in Buffalo, New York, and graduated in 2017 with a bachelor's degree in finance and economics. I began my career as an analyst at a commercial real estate broker in Buffalo, New York. I spent a little over a year there and learned about the inner workings of the commercial real estate industry. I passed the CFA Level 1 exam while working there in June of 2018. In December of 2018, I moved to Columbus, Ohio to work at Ohio Public Employees Retirement Systems as an investment analyst. When I joined, the retirement system had roughly $90 billion in assets under management, and the U.S. equity team I was a part of was responsible for roughly $2 billion of that. At OPERS, we actively managed the portfolio, and I provided investing ideas across many industries, including financials, industrials, materials, and others. I worked at OPERS for roughly 2 years, along the way learning an immense amount of information about investing, the industry, and myself, as it was the first time I'd ever lived alone on my own. In June of 2019, I passed the CFA Level 2 exam, and after having the Level 3 exam canceled on me twice due to COVID, I plan to sit for it this May. I first met Justin and Peter in 2018 after my neighbor introduced me to them. Over the past 3 years, Peter, Justin, and I regularly talked about different investing ideas, books, and articles that we found interesting. Our conversations provided insights into how the portfolio at O'Keefe Stevens was managed, why certain stocks were in the portfolio, and a general framework and philosophy of the firm, and most importantly, a friendship. What excites me the most about this opportunity is to continue to learn from everyone here at O'Keefe Stevens and to continue my value investing journey at a place that I know views investing the same way I do. The first investing book I ever read was The Intelligent Investor, and as Warren Buffett often says, either value investing hits you right away or it never does at all. I think it's safe to say I fully embraced the philosophy. Lastly, over the coming months and years, as we put COVID behind us, I can't wait to meet you all in person and build lasting relationships.
I'm delighted to be partnering with Dominic, and the objective of our firm is to constantly grow and improve our research process. Given that we have a very different view of the investment world with our approach, it's a blessing to connect with Dominic and a value approach that so closely matches our philosophy. As the performance of value investing appears to have improved, we're looking forward to the benefits of having greater resources to make this transition with Dominic as a part of our team. Justin?
Yeah. Good. Well, it certainly is an exciting time here at O'Keefe Stevens, and there's been quite a run-up in the markets and the values of our portfolio during the recent months. From the beginning of the year through March, the S&P 500 is up nearly 7%, and our portfolio is up over 12%. The bulk of those returns are coming from segments of the market that were slow to recover due to COVID-19 reopening restrictions. This chart that I have on the screen is from JP Morgan's Guide to the Markets, and it shows the year-over-2-year changes to high-frequency economic activity. So these are items that can be tracked in almost real time and give us a good idea of consumer behavior. Because 70% of our economic output is consumer-driven, looking at these charts helps us get a sense of where our economy is headed in the near term. So the lines at the top of the chart show that consumer credit and debit card spending held up, and this was mainly due to the shift from in-person to online spending. So although there was a drop in spending during the early months of the pandemic, U.S. consumers found ways to deploy their incomes and stimulus checks despite the closing of many businesses. Spending on housing was a bright spot during the pandemic as more people shifted to a work-from-home environment. We saw an uptick in the demand for housing. This demand continues into 2021, and new housing starts are at their highest level in the last 5 years, according to data from the U.S. Census Bureau and the U.S. Department of Housing. So this demand is driving up the price of materials, and it's creating a boon for investors who held on to their cyclicals. Our investments in land that's used for development and in copper and in timber are benefactors of this recovery in housing. The lines at the bottom of the chart show consumer spending on travel and dining, and that they still have not fully recovered, although you'll see the demand for these services is picking up quickly. We believe this trend is going to continue through the course of the year as more and more people around the globe are vaccinated and we approach a herd immunity to the COVID-19 virus. We do believe there's a lot of room for economic growth to continue in 2021, and the economy is still far off its historic trendline growth rate, and that's due to the restrictions on reopening businesses and overall consumer caution. Our belief is improvement is going to continue, and 2021 will be a banner year for economic growth. It's interesting to look at where the market growth is coming from in 2021. So this chart shows total returns by sector over 2 time periods. The gray bars show returns from December 31st, 2019 through November 6th, 2020, which was the day the Pfizer vaccine was announced. And the green bars show returns from that November 6th date in 2020 through the end of the first quarter. And the first observation is that the winners and losers have effectively swapped roles since the vaccine was announced. The energy, travel, real estate, and financial sectors, which declined the most at the onset of the global pandemic, have since experienced outsized returns as investors are now feeling safe allocating to these uncertain and sometimes deeply undervalued segments of the market. Likewise, the sectors that performed so well during the shutdown, which were consumer discretionary, mainly via online shopping and home improvement, and the technology sectors, those have experienced more modest or even slightly negative results since the announcement of the vaccine. So investors piled into these stocks during 2020, and now many of these companies are looking richly valued, and there's been quite a bit of profit taking in the technology space. And the largest companies in the market, known as mega caps, are also seeing investors pull money and deploy them in a more attractively priced segment of the market. So here at O'Keefe Stevens, our portfolio is benefiting from this shift in investor sentiment. We have a larger allocation to energy, to travel, and real estate and financials than the overall market. And so while we do own some technology investments, our recent results have really been driven by the smaller, more cyclical businesses that we've held on to and that we were adding repeatedly to during the last 12 months. So looking at overall market valuations, it's clear that stock prices are high from a historical perspective. The price to earnings ratio of the S&P 500 is near its higher range from a historical perspective. Now, generally, this would suggest to us that broad market returns will be lower in coming years. However, today, we think that this high multiple is likely to come down as earnings are still recovering. The market is probably not as overvalued as this single ratio would suggest, and that's due to the strange circumstances that were created by the pandemic. Interest rates are ultra low, and this has also created an environment where stocks really ought to be priced slightly higher because they offer more attractive returns than stable fixed income investments. As interest rates start to increase and earnings results return to normal, we think this expensiveness factor of the market will back off a bit, and we don't expect multi-year results to be as low as this high PE ratio would historically suggest. When we look at the possible scenarios for the year ahead in 2021, we have to consider what type of an environment we're going to be in. This chart shows a matrix of 4 macroeconomic environments for investors, with the focus really being on inflation. So at the top left of the chart, there's a high and rising inflation environment. At the top right, a high and falling inflation environment. And in the lower right, we have a low inflation environment with falling inflation, and that's what we experienced in 2020. So results for the year were favorable for equity and fixed income investors, although you can see in comparison to the other environments, the overall results are stunted when inflation is low and falling. And that's due to overall lack of growth. So commodity price returns historically have suffered the most in that type of environment, and that was also the case in 2020. So where we find ourselves today in 2021 is at the bottom left of the chart. We're in a low inflation environment, and we expect inflation to rise in the next 12 months. We're already starting to see signs of that. And commodity investments perform much better in this type of an environment, and equity returns are also stronger, especially in emerging markets. So historically, fixed income investments perform better in this situation too, but we as a team remain especially cautious of fixed income because of interest rate risk. Finally, we have some positive updates on the state of value investing to share with you today. Peter mentioned this earlier. The chart on the screen shows how growth strategies have trounced value in more recent years, with the prior decade being heavily favored to growth investors. the end of the last year, though, we did see a reversal in the fortune of value investment strategies as value investments outperformed growth investment strategies for 3 consecutive months. This is significant. It hasn't happened since 2016. And while the near-term recovery for value investors is still quite small compared to their longer-lasting underperformance, we do see the tide starting to shift. And questions are being raised about whether the tide is turning for value managers like us. The last time value investments outperformed growth by similar margins as we see on the chart, the value resurgence became very meaningful. And this happened in the late 2000 market after tech stocks had crashed. So from that point forward, value stocks beat growth stocks handily by about 16% over the next year after having lagged growth stocks by over 17% just 9 months earlier. So this decade-long run of underperformance for value funds, especially with the huge gap in 2020, also resulted in a significant widening of value's longer-term underperformance against growth. And as we saw earlier, that goes for 3-year average annual returns, 5-year track records, and even the 10-year returns that I showed on the slide earlier. So for the 10-year period ending December 31st, 2020, large value stocks underperformed growth stocks by 147.2 cumulative points. And that's the widest difference since 1999. But as you can see on this chart here, the green boxes indicate value outperformance for 10-year periods. And following the tech crash in the year 2000, 10-year returns for value investors exceeded growth investor returns, and that lasted for several years. So at the end of 2020, the gap between growth and value results was the widest it has ever been since 1999. It seems that markets are becoming aware of the expensiveness for growth companies. Lots of that growth was fueled by accommodative monetary policies and low cost to borrow for corporations. When these trends change, the patient investors who've held stocks in fundamentally strong businesses should be well positioned to gain momentum as dollars are reallocated to traditional value investments. So our team is sticking with value because investing this way makes intuitive sense to us. While the experience as value managers has been rough in more recent years, the long-term results are still compelling. And furthermore, the thinning of the ranks amongst value managers and the surge in indexing has created an opportunity for active managers like us to go out and find pockets of deeply discounted shares in well-financed and well-managed businesses. We think of ourselves as owners of these businesses when we buy the stocks, and we need to stick with them for many years to see results. So Peter is going to share a really interesting piece from our investment process now, our 10 guiding beliefs when it comes to owning stocks and building your portfolio. Peter?
Thanks, Justin. One of our objectives of our quarterly call is to share a part of our investment process so that you're confident that we're acting as responsible stewards of your money. As Justin said, we have 10 beliefs that guide our investment process. These beliefs have been developed over many years and are the products of the thoughts of some of the world's greatest investors, and some are just plain old common sense. Since our investment process is evolving, we're open to adding or deleting beliefs as appropriate. I'll list our 10 beliefs and then make a comment or two. If you require any additional clarity, please ask about them in the question and answer session or give us a call at any time. Our 10 beliefs are: consider risk, buy value, be different, be patient, be unconstrained, don't forecast, history matters, the golden rule, use leverage carefully, and be familiar with your investments. Let's look a little closer at each of these investment beliefs now. Our belief number 1 is consider risk. Risk comes in many forms. Some are universally related, such as market risk or the tendency of stock prices to swing based on investor sentiment at any given moment. Often risk is company specific, such as technology risk, the potential that our products become obsolete or outdated. To avoid this, we desire to own investments that devote significant funds to research and development. Considering the downside or looking at what can go wrong, in our opinion, is simply the most important thing we can do. Our second belief is to buy value. We are firm believers that understanding the value of what we own and only purchasing investments when we believe we are buying at a significant discount to our appraisal value. By having a margin of safety at the heart of our process, it minimizes the risk of us overpaying. Our third belief is to be different. We believe if we view the world in an unconventional way, we can have greater insight than by following the crowd. As you may well already know, our thoughts on diversification, holding periods, size of positions, and investment theory are far from mainstream. Our fourth belief is to be patient. With our long-term view, many of our investments can take several years before other investors become attracted to them. NVIDIA, Corning, Qualcomm, Weyerhaeuser are but a few of the many investments that required a great deal of patience. We see this as a critical ingredient in our investment process. Our fifth belief is to be unconstrained. Great investment opportunities manifest themselves in many different sizes, locations, and industries. We're willing to own small, medium, and large-size company in every sector. In addition, we're also willing to own both domestic and international investments. Our sixth belief is don't forecast. We simply don't believe that forecasting the economy, markets, interest rates, or other events is a reliable investment policy. Our focus is on trying to understand the facts and investing only when we believe we can achieve an acceptable return with minimal risk. Our seventh belief is that history matters. In John Kenneth Galbraith's book, A Short History of Financial Euphoria, he states that there can be few fields of human endeavor in which history counts for so little as in the world of finance. We believe that history does matter and are students of financial history, and we believe that many valuable lessons can be derived from past financial successes and failures. The eighth belief, the golden rule. Over my 41-year investment career and in life, the idea of being a responsible steward is the surest way to success. Like I stated earlier, some of our beliefs are just plain old common sense. Our ninth belief is to use leverage carefully. Too much debt is almost always a contributing factor to business bankruptcies. In recent years, low-cost debt financing has become a wonderful tool for skilled managers. Given that leverage is a double-edged sword, we believe it should be used with great thought and care. And finally, our 10th belief is be familiar with your investments. Since almost all investment professionals are compensated by the value of the investment assets that they manage, it's puzzling that so few are truly intimate with their investments. We see many benefits with having a deep understanding of our investments. Key among these is the ability to have a relatively concentrated portfolio and a conviction to add to our positions when they have a significant decline in market value. While our beliefs are not carved in stone, they probably should be, as we rarely make any substantial changes to them. Next, I'd like to talk about the next wave of technology convergence. There's a tendency for technologies that were originally unrelated to become more closely integrated and even unify as they develop and advance. For example, telephones, televisions, and personal computers began as separate and mostly unrelated technologies. The telephone was invented in 1876, and its use grew dramatically in the early 1900s. The television was invented in 1927 and grew dramatically in the early 1950s. And the personal computer was invented in 1975 and grew dramatically in the 1980s. With many technological improvements, the telephone, television, and personal computer have now converged into one. Along with their convergence was the opportunity to build wealth for both businesses and investors. You may be saying to yourself, this is an interesting history lesson, but what does it have to do with me? Well, what if we were aware of the next major convergence of technologies and invested early in some of these leading companies involved in that process? So, what are some of these technologies, and how can we benefit by being early investors in the convergence of these technologies? After listening to numerous investor presentations, quarterly calls, and reading annual reports, I've become aware of some of the exciting new technologies that are becoming big businesses and offer significant investment opportunities over the next several decades. The three transformational technologies I would like to briefly discuss today are wireless, cloud, and the internet. Wireless is simply the process of information transfer between two or more points that do not use an electrical conductor. The most common wireless technologies use radio waves. Wireless is far from new, as the first wireless telephone conversation occurred way back in 1880 when Alexander Graham Bell and Charles Sumner Tainter invented the photophone, a telephone that sent audio over a beam of light. A wireless revolution began in the 1990s with the advent of digital wireless networks, leading to a social revolution in the paradigm shift away from wired to wireless technology. Some of the examples of these are pagers, cell phones, and laptops. The wireless revolution has been driven by advances in radio frequency and microwave engineering. Cloud computing is the next technology. Cloud computing is the on-demand availability of computer resources, especially data storage, without direct active management by the user. Cloud computing relies on sharing of resources to achieve economies of scale. The idea of data sharing began during the 1960s when sharing became popularized as remote job entry. It was most closely associated with large vendors such as IBM. The availability of high-capacity networks, low-cost computers, and storage devices has led to growth in cloud computing. The goal of cloud computing is to allow the user to enjoy the benefits of all these technologies without a deep need for a deep knowledge or expertise. The cloud aims to cut costs and help users focus on their own businesses instead of being impeded by information technology obstacles. For example, O'Keefe Stevens uses the cloud to store our data, and this allows us to focus on our research and our clients. The modern cloud computing business began in 2006 when Amazon created Amazon Web Services. And finally, the internet. The seeds of the internet began in the 1960s with the desire of universities and other research organizations to share information. In the early 1990s, the internet that most of us know so well had begun to unfold. From my reading and studying, it appears that wireless, cloud, and internet are moving towards converging. As clients of O'Keefe Stevens, we own 4 businesses that we believe are well positioned to benefit from this transition: Corning, Intel, NVIDIA, and Qualcomm. Each of these 4 companies are leaders in areas that will benefit from the convergence. The first is Corning, the inventor and dominant supplier of fiber optics, and they stand to benefit from the rollout of 5G, the 5th generation of wireless. Intel is the inventor and dominant supplier of microprocessors, or the CPU of the computer, and they stand to benefit from growth in cloud computing. NVIDIA is the inventor of the graphics processing unit, or GPU, and is a leader in the field of visual graphics. NVIDIA stands to benefit from cloud and high-performance computing. And finally, Qualcomm is the world's leading wireless technology inventor and the driving force behind the development launch and expansion of 5G and will benefit from the so-called Internet of Things as thousands of devices will become connected to the Internet. While there are numerous companies that will benefit from this convergence, we believe we are well positioned to not only participate in this growth, but we're able to purchase these investments at great prices when they were unloved and unwanted at the time of purchase. I anticipate we will continue to discuss these investments more in depth in the future. You just need to sit back, be patient, and enjoy the ride. Carly?
Thanks, Peter. Now we're going to move into the question and answer section of this call. If anyone has a question, please type it into the question chat box, and I will read it to Justin and Peter to answer. We have received a couple of questions so far, but the first one Justin and Peter are going to address is regarding the larger amount of cash being held in client portfolios at this time.
Thanks, Carly. Pete, I'll answer this one first. We sold the position in Discovery Communications during the month of March, created a sizable amount of cash into the portfolio, and we've been holding off on reinvesting that. We've talked to many of you about the idea of getting an option contract written to repurchase that stock if it falls below a certain price, and we're continuing to roll out that effort so that we might be able to do that. As it stands right now, we're not interested in repurchasing Discovery at the current prices, but if it does drop to where we are interested in purchasing it, we'd love to repurchase that fabulous business. And if it doesn't in the next couple of months, we do have other plans. Peter and Dominic have been researching quite a few other businesses, and while we're not going to share the names of those businesses on today's call, you can be assured that we do have every intention on getting that money back to work. Peter, would you add anything to that?
Sure. A little bit of update on that is the price of Discovery has dropped off again, and it is very close to where we're interested in owning it again. But we do have an outsized position, and that outsized position in cash gives us the opportunity to find investments that we find are attractive. So, Carly, why don't we go to the next question?
Okay. Our next question comes from Jerry. He said, is there a decision pending pertaining Fannie Mae by the Supreme Court? If so, when and what might be our expectations? Thank you.
Sure. The hearing with the Supreme Court took place in early December, and we're expecting a decision from the Supreme Court by June 30th. Justin, anything you wanted to add?
No, I mean, I'd say we're kind of on the goal line with that one in terms of an expected result. And what the price of the stock has been moving around pretty rapidly, up and down in the recent months, but we do not have any reason to, I think it's just some jockeying around with people wanting to get in or out of it. My thought is that we need to wait for that Supreme Court hearing. So early this summer, we would expect that the facts are on our side, and that would produce a favorable result for the preferred stock, especially.
In the last week, there's been significant upswings on the stock. I've looked at a number of avenues to see if there was any news, and haven't found any news that indicates anything different from what we already know. So we're looking forward to the Supreme Court ruling, and we believe that it only makes sense to move in our direction at a favorable outcome. Yep.
Great. And Peter, you referenced economies of scale when you were talking about cloud computing earlier.
Sure.
Can you provide more information on that?
Sure. Economies of scale are achieved when you have a number of users using a particular technology or anything to bring the cost down. So it's just a way of making things more efficient. So instead of, for example, if we use something like a lawnmower as an example, most of us mow our lawn once a week. but we have tremendous economies of scale if 10 of us in the neighborhood purchased it and we were sharing that, and it would naturally bring the cost down for all of us that were using it. And that's exactly what happens with the economies of scale with computer equipment that has made cloud computing so beneficial. Anything you want to add, Justin?
No, I think the reference made to economies of scale as it relates to your question is really what Peter talked about. Is as more and more users come online, the costs come down. It's very expensive to develop technologies on the front end, and companies that do that, they invest a lot of money up front with the expectation that those technologies will last for quite some time, and they will achieve favorable results as the cost comes down to roll things out. We've seen that happen over and over again in technology.
Okay. We have another question that comes from Mikhail. When referring to the energy sector, are we talking about oil? Are we talking about solar panels, or both of those kind of things?
So the energy sector encompasses both those things, although we're starting to see the energy sector kind of, I would say, bifurcate into the new energies of like solar, wind, hydro, and then your old technologies like oil, coal, even nuclear. So our energy sector would encompass all of those things. We've found some surprising values in some of the older energy technologies, especially today, because the popularity factor for new energy technologies is through the roof. And when the popularity factor for new things is through the roof, the price of those stocks tend to be hyperinflated and not really in our buy zone. And vice versa, it's pushing down your legacy energy producers like oil and coal. And so we've been able to pick up some really fabulously managed businesses that have still a lot of productivity left in their life at very reasonable prices.
So we're in the midst of, and will continue for the next several years to see an energy transformation away from some of the less environmentally friendly energies like coal, and move more towards natural gas as an in-between, and ultimately wind power and other energy technologies such as that. So thanks, Mikhail.
All right. We have another question that comes from Jeff. Says that AMD is a market leader in CPUs and GPUs, the Pepsi to NVIDIA's Coca-Cola. Unlike NVIDIA, though, they manufacture and lead research on both. Thoughts on their value?
Peter, you go ahead, because you've studied at AMD in not as equal to NVIDIA, but you've looked at it quite a bit.
Sure. We originally purchased NVIDIA in the year 2013. At that point in time, that stock had declined about 68%, and had grown revenues dramatically, was highly profitable, had been buying back their stock, had begun paying a dividend, and we could buy it at a fraction of its or at right about book value. And given that they had a significant amount of cash and no debt, it was a very compelling investment. At that same time, AMD, which had been losing market share to NVIDIA and to Intel, was up to their eyeballs in debt, had negative cash flows, was not able to pay a dividend, and it was, from the way we view things, we simply couldn't touch that. They've made a remarkable turnaround, and I applaud them for the turnaround that they've made. Although NVIDIA did announce, I think it was 2 days ago, that they're going to be building a CPU. So they now are in competition with both Intel and AMD, and have done research in that. And in the announcement, they said that their CPU is 10 times more powerful than Intel's. Intel is a 100-pound gorilla. They have a dominant market share in the CPU market. But we do not own any Intel, and I'm sorry, we do not own any AMD. We do own Intel.
Yeah.
Justin, you want to add anything?
No, I think, AMD has been a fabulous stock, as has NVIDIA. I applaud the investors who were able to see through the challenges that they faced in 2013. Our rationale for not owning AMD and owning NVIDIA really comes down to we have a huge concentration to NVIDIA. Well, AMD is a much better business than it was 7 years ago. We're up to our eyeballs in NVIDIA, and we don't really have room to add another position like it to our portfolio at this time. And as we talked about earlier, intimate familiarity with the company at NVIDIA would really be hard to replicate with another company in that same space, given the amount of time Peter spent on the business.
All right. Our next question comes from Krista, and she said, Peter mentioned future technologies of wireless, IoT, and cloud. Where might blockchain technologies fit in, if at all?
Try to tackle that one.
So, I mean, yeah, I think we're going to see all of our computing companies have a touch point on blockchain technology in terms of the processing power that's needed to run those technologies. We don't have any direct investments in blockchain currently. I would say NVIDIA experienced a huge run-up in 2019 with cryptocurrency mining being kind of the focus of that run-up. And it actually created a real problem in NVIDIA's supply chain for quite some time. And when that craze ended with the steep decline in the price of cryptocurrencies, NVIDIA's stock took a huge hit in the fourth quarter of 2019. Yeah, Dominic has something to say on that too.
Yeah, so with blockchain, you could see it really impact the financial sector. Right now, when you buy and sell any securities through like a TD Ameritrade brokerage account, it'll take 2 days to settle the transaction. In the future, you might be able to use some sort of blockchain technology where it settles the second you buy a security. If the money might just be withdrawn from your account right away, the transaction, since you're matching the buyer and seller, you could settle the transaction immediately. You could say the same thing on like the ACH side, where I believe it takes a couple days to complete an ACH transfer. You could use blockchain going forward. That might, again, match the transfer parties and make the settlement same day instead of 2 days out. Who the ultimate benefactors are, I think it's going to be really tough to say going forward. You're, again, in your infancy stage. So, I mean, we'll keep an eye out on ideas and names that might benefit from it going forward. I just think you're such an early stage that is probably tough to identify right now.
One company that we do own that does benefit of that is NVIDIA. They have their chips are used for cryptocurrency mining, and so they now have a separate chip that is specifically designed for that market. And they're since they are the high-end chip maker for crypto mining, that is the preferred chip to be used. On Monday, NVIDIA announced that they had originally expected about 50 million in chips for crypto mining to be sold. They've tripled that number to 150 million. So it's still a very small portion of their business, but it's obviously a very rapidly growing aspect of their business. Where that goes in the future, it's uncertain. I've done a lot of reading on Bitcoin in particular, and at this point in time, I would say I'm far from really I'm well overwhelmed by trying to understand what exactly it's all about.
Okay. And our next question comes from John, and he said, We have been discussing the cloud. Have you looked at data storage investments?
Yeah, I mean, there's the chip making companies that we own, Intel and NVIDIA are central to data storage and data centers. I think if I read into your question a little bit, maybe you're talking about from a real estate perspective, and actually these facilities that house these huge data centers. I have not looked closely at that type of real estate investment, although I'd say my, just peripheral understanding of that space is that it's experienced quite the run up in price, and that those are probably not bargain type investments at this time. I do not have any specific names that I would point to, though, because we haven't really done a deep dive there. But thanks for bringing it to our attention.
Now, the data center companies that are on our horizon are companies like Google, Amazon Web Services, and most of those data center companies, we provide chips either through Intel or NVIDIA to service that market. So the data center is the fastest growing aspect of NVIDIA, and I would anticipate this next quarter will be the first time that it's larger than the gaming portion of their business, which is where they originally began. So while we don't have direct investments in Amazon or in Google, we certainly are participating in that storage area.
I do love the economics of the business model, though. There's going to be this. We're talking about 5G and how many things connect to the internet, and just with the amount of data that's going to need to be stored, it's an ever-expanding pipeline for these businesses. So really, really interesting future there that would make sense to have a deep understanding of, because it's not going anywhere.
One of the areas that we haven't gotten any questions on is wireless, and the transformation into the 5G literally began in late 2019, and all you have to do is watch a little bit of television from the various telecommunication vendors. 5G has just begun to move forward, and it's going to be well beyond telecommunications. It's going to be moving into manufacturing, automobiles, and literally every aspect of our life. And all of our devices are going to be interconnected to the internet. And as I said, sit back and enjoy the ride, because it's going to be phenomenal to be watching how these technologies change our life moving forward with things that we have never ever dreamed about. And we had that happen with 4G as well. Whoever heard of an app prior to 4G coming on board? Yet now we're using these apps on a fairly regular basis in our lives. While I can't pinpoint the new areas, I'm looking forward to the creativeness of many entrepreneurs who move into that area and make the most of that technology.
Great. It looks like we went through all the questions that have been submitted so far. We will put ourselves on mute for about a minute or so, just to give you guys time to ask any more questions if you'd like to. We'll be right back.
Was there another question?
Yes. All right, we got one more question, which is, what is your stance on environmental sustainability in terms of its future in the market?
I'll chime in there. I think we're seeing all sorts of companies embrace environmental sustainability and governance factors at the corporate level. So, even our largest holding, NVIDIA, has been applauded for their efforts there. While I think it's really important from a social standpoint, it's not one of our primary screens for our investments, but I do think it kind of comes across as a secondary screen. Companies that have good governance and are environmentally sustainable tend to have a lot less political risk, which is something we would almost always try to avoid in any investment that we make. There are quite a few investors who that is their primary screen, and one of the shortfalls I see to that is that it really puts you in a box in terms of where you can go. So I love the social impact that's being brought to the markets. It's not our primary focus at this point. I should also ask our research team, who's sitting across from me, how they feel about it, though.
I'm in agreement with you, and I would also add that we own a number of companies, and Weyerhaeuser is the one that immediately jumps out at me, given the fact that they own lots of trees and an incredibly environmentally friendly business. But it's not the only business that we own that's environmentally friendly, but certainly one of the standouts, and NVIDIA is in that same category as well. Would you like to add anything?
Sure. I guess I would just say companies that are in business to benefit everybody involved, whether it's the customer, employees, just civilization as a whole, are probably going to be better off in the future than ones that just ignore that type of aspect and are just in the business for profits. So I guess I would just echo, I don't think it's something we would ever say we're not going to invest in this XYZ company because it's not environmentally friendly. I'd also say that I would assume that we're probably going to be focused more on businesses that do like to benefit all stakeholders involved, as there'll be better investments more likely in the future.
Agreed.
Okay. Looks like we've answered all the questions, so this ends our quarterly investor call for today. As a reminder, you can send in any questions you'd like answered by Peter or Justin or Dominic on this call in advance to any member of our team. We look forward to addressing your future investment questions on these calls. Thank you for tuning into our commentary on the market and your investments. You will be able to replay a recording of this call within 24 hours on our website at www.o'keefestevens.com.